How much does it cost to buy a second home in London? Well, by the end of this video, we're going to find out, so make sure to stay to the end so you can factor the right budget. Hi, I'm Arinzeh with Onyx Property Consultants in Keller Williams. I am a London-based property agent and I help my clients find the right property, whether they're buying, selling, renting, or managing here in London. If you're new to my channel, please make sure to subscribe because I put out weekly videos about the London property market and everything that's happening in this fabulous city. In today's video, we're going to be talking about the costs associated with buying a home in London. So make sure to stay to the end because I'm going to give you real-world examples of exactly how much it's going to take. So just as a quick overview, the average home price in London is at about £470,000 and yields hover around just under 4%. Most investors historically have been attracted to the London property market because prices have gone up so much over the years, and it really is a very stable investment, especially relative to other investment considerations you might want to make. Now, once you've got a sense of the average cost of buying a home in London, the first question is what kind of budget you might have and whether you're going to be paying cash or will you need a mortgage to help finance that purchase. If you will need a mortgage, generally speaking, most lenders will lend from 60 to 75% of the purchase price amount or loan to value on the mortgage that you'll be able to achieve. As a buy-to-let or rental property, you will need a special buy-to-let mortgage, and the difference is those can be offered on an interest-only basis. And while that might sound good in that you're only having to pay the interest portion, it means that over the life of the loan, you haven't paid down the loan amount or the original principal amount at all, and you'll have to rely on either selling the property or perhaps even remortgaging to pay off that original loan amount. Buy-to-let mortgages typically will be at a higher cost than your owner-occupier mortgages. They might have additional fees. The loan-to-values might be less. And why is that? Because it is perceived as a greater risk. Because the bank is reliant, or you are relying on the rental income that will come off of that property to pay that interest expense. It means you might be exposed to void periods or times when the property is not occupied. You're relying on market conditions that will dictate the amount of rent that you're able to achieve, and all of those things create more risk for the bank, and therefore they're going to have greater restrictions and higher costs associated with it. Most investors will generally try to get as high a loan of value that they can achieve or get from the bank, and that's not a bad idea considering that interest rates are still historically low. Therefore the interest that you're going to be charged on that is relatively competitive. You're going to have to actually balance that against the actual rental income you'll be able to achieve, because as an investment property, you're going to want that rental income to be able to cover that mortgage as well as any additional costs that you're going to have to pay in owning that property. Next, you're going to have to consider the actual interest rate you'll be able to achieve, and that's generally a function of the loan amount, your financial situation, the rental income you'll be able to achieve, and obviously where interest rates are overall. There are three major types of interest rates that will be quoted. The first is a tracker mortgage. That is what we as Americans might consider a variable rate mortgage. It is a percentage over the Bank of England rate, and that can change over time. Right now, the Bank of England rate is at 0.75% and has been there since August of 2018. So it's been at those low rates and doesn't really have much more room to go down. Next is a discounted variable rate, and that is usually a discount from the bank's standard rate. So say a bank's rate is, say, at 5% and the discount is 2%, then that means the rate you'll be paying is 3%. Now, if the bank's rate does change over time, your rate will change as well. But generally, that discounted variable rate is in effect for about 2 years. And then after that, if the bank's rates change, your loan amount will change as well. Or after that, it'll kick right into the bank's standard rate at the time. Then there are fixed rates, which are set fixed for a period of time, and that's generally for 2, 3, 5, or 10 years. For Americans, that might be surprising that you can't get 30-year fixed mortgages, which we're very used to seeing in the States. But here it's really maybe you can get up to 10 years fixed. And then after that, your rate will convert to the bank's variable rate, standard rate, or if you can look to then remortgage the property or refinance, as we say as well. If you're able to get an interest-only rate, note that banks might reduce the amount of loan-to-value you could get. So let's say you were doing a repayment mortgage that had an element of repayment to it. If you chose to only do an interest-only, some banks might only lend up to 60%, whereas under repayment, you might be able to get up to 75% loan-to-value. So say you had a £1 million property you wanted to purchase, and given that rates are historically low, some of the best repayment mortgage rates that we're seeing is a 25-year term with a 60% loan to value at 1.58% fixed for the first 5 years, and then 4.24%, which is the bank's standard variable rate after that. It means mortgage payments of £2,422 per month for the first 5 years, and then increasing to £3,073 a month thereafter. But say you wanted an interest-only mortgage, then in that situation, that same bank might reduce your loan to value down to 50%. So that means instead of you having to have equity in the 60% loan to value situation of £400,000, if you were doing interest only, you would now have to have equity of £500,000 to bring to the table at the start of the mortgage or the purchase. But your initial period payment would only be £504 per month for the first 5 years, and then increasing to £1,766 per month thereafter. In this case, I would highly recommend that if you are generating excess cash flow from that property, you are sure to set that aside so that you do have enough to start repaying that mortgage over time, or just really throwing that money at that principal payment, which will reduce the amount you'll have to pay at the end of the term. Given that rates are still historically low, you might want to lock in for as long as you can the low interest rates at that fixed rate, so that when rates start moving up, you've got a longer period of time where you've benefited from that lower interest rate that you were able to lock in today. Make sure to discuss your options, not just with your bank, but also with a qualified mortgage advisor who can look at the entire market to find where some of the best rates exist. You also do need to be aware that there might be additional costs for arranging that financing. Some banks cost maybe £1,000 of the arrangement fee, or there might be additional costs just to set up the mortgage, and they can range from 0.5 to 1% of the costs associated, as well as making sure that if there are arrangement fees, you're aware of them. And then there might be repayment penalties if you want to pay down that mortgage or pay off that mortgage during that fixed rate term. So make sure you understand all the costs associated, and does that match up with your time rate and time horizon to own that property. The next thing you're going to have to consider is stamp duty. Stamp duty is a tax on purchase, and I've mentioned this several times before in some of my other videos, so make sure to watch my video on stamp duty to get clear on all the components that you're going to need to know to factor that in. For purposes of this video, the key thing to remember here is that stamp duty for a second purchase will incur an additional 3% on top of whatever rate it qualified for if it was an owner-occupied rate. Since the calculation is quite tier-based, you're going to want to use a stamp duty calculator, and I'm going to include one in the comments below that you just click on, put that budget in, and get a sense of how much stamp duty you might have to pay. As a quick demonstration though, let's say your budget was £1 million. Using that stamp duty calculator, if it was an owner-occupied property, the stamp duty associated would be £43,750. But if it is a second property or a buy-to-let property, that amount jumps to 73,750 pounds. So again, it's a significant cost that you're going to want to account for, because you're not going to be able to roll that into your mortgage. You're going to have to add that to the equity you're going to have to bring to the table at the time of purchase. So have you been considering a buy-to-let mortgage? Make sure to leave me a comment below and let me know how the process is going for you. So after you've factored the cost of your mortgage or interest rate payment as well as stamp duty, the next thing you're going to have to factor in are conveyancing costs. You're going to have to hire a solicitor to do the conveyancing, which is all the legal and title work associated with making sure that when that property gets transferred to you at purchase, it's clean and in good hands. Costs associated with conveyancing might depend significantly depending on such variables as even whether you use a London-based solicitor or someone outside of London. There's some shops that are kind of conveyancing factories, so you definitely want to be careful, because in the case of conveyancing, you want a solicitor that is going to work diligently to push your deal through in a timely manner. One of the things I know as an agent is that time kills deals, so you definitely want a solicitor that is moving the process quickly. But generally speaking, the costs associated with the conveyancing process might be anywhere from about 750 pounds to maybe 2,000, 2,500 pounds, depending on the size of the property, the purchase, and again, being really mindful of the quality of the solicitor, the firm that's representing them, and do they really kind of know you personally. So you're going to want to get perhaps referrals on that, and if you have any questions of who you might be working with, get in touch, because we can definitely give you some perspective. Another cost you're going to want to factor into your budget of owning a buy-to-let property is the service charges or ground rent, which are going to be indicative if it's a leasehold or freehold property. I've got a separate video on leasehold versus freehold, which explains that whole concept. But again, the service charges and ground rent are the costs of maintaining that property if it's in a property or in a building with other units. You're going to want to factor that in, because it's unfortunately not a cost you're going to be able to factor or pass on to your tenants. You're going to have to incur that directly yourself. Additional costs that you're going to want to factor in are council tax bills, but you'll only pay that during the period of time that the building or the flat is vacant. It is a cost that you'll be able to pass on to your tenants. In addition, there's building insurance, contents insurance if the flat is furnished, furnishings and other decorative items if you offer it as a furnished property, maintenance and repairs, property management fees that you're going to pay to a third property manager, especially if you're overseas, keeping up with notices and posts. So again, there might be costs if you're sending your post and mail to other places. And when properties are unoccupied and they settle, dormancy issues might arise with pipes, boilers, and other maintenance and repair issues you're going to want to set aside funds for, to make sure when they do arise that you're able to cover them. In addition, there's annual compliance issues like gas safety checks and security and oversight, especially say if you own the property in an offshore vehicle. There might be costs associated with maintaining that entity and staying in compliance for those overseas vehicles. So in recap, in today's video, I've given you several key components that you're going to need to factor in when you buy a property and then own it over time as well. Now let's review with an actual example. On a budget of £1 million, your stamp duty would be £73,750, with conveyancing costs estimated at the high end of £2,500. With a 60% loan to value, you'll need to bring £400,000 of equity. Then for ongoing costs, first are the financing costs. At that 60% loan to value, assuming you go for a 5-year fixed rate at say 1.58%, your repayment monthly mortgage is estimated initially for those first 5 years at £2,422 per month, with a £999 mortgage fee. If you have a service charges and ground rent, I've estimated those at about £400 a month. So to break even and cover your mortgage, you would need rent of approximately £3,000 per month and would need to factor in property management fee of about 7%, which is £210 a month paid to the property manager. As a final note, as an overseas landlord, you are subject to the government's non-residential landlord scheme, which is a tax scheme that you're definitely going to want to make sure you're familiar with and you stay in compliance. Make sure to watch my video on being a non-residential landlord or an overseas landlord to get all those key components that you're going to want to make sure you're aware of. So do you have more questions about a buy-to-let investment? Make sure to sign up for my emails where I can give you great advice and perspective and tips on owning a buy-to-let investment. We also feature properties that might be good potential buy-to-let investments for you. If this video has been helpful, make sure to like and subscribe. And if you have any questions about the buy-to-let market, make sure to leave it in the comments below. Or if you're finding great deals out there on buy-to-let mortgages, make sure to share it with us as well. Don't forget to watch my other videos on the Investing in London series that give you top tips about being an overseas investor, or actually if you're domestic as well and own a buy-to-let property or want to build that portfolio, all the things you're going to want to do to make sure that you're making the smartest investment out there. So that's Arinzeh with Onyx Property Consultants and Keller Williams. Bye for now.